Well, they say in the market, buy the fear, sell the greed. Now, if you sold at higher levels, is it time to buy the fear? A lot has changed in terms of the market rhetoric and narrative. Markets have fallen because of high valuations and slowdown in earnings, but in terms of the total global sector, where do we stand? Budget has been an impetus for this for the market, but where is the government capex cycle headed? Trend from 2000 to 5000 to 8000 back to 5000. Where is the next big pot of gold in the entire retail and consumption space? So the minute I say trend, my viewers know it that we are talking about Milind Karmarkar, who would be joining us on this edition of Market Maker. So nice to have you back. Thank you for joining us.
Thank you. Thank you, Nikunj. Nice to be
Last
here.
time when we met, there were excesses.
Yes.
There were excesses in the small and the mid caps.
Correct.
Now, are there excesses? I mean, there were excesses on the upside, but are there excesses on the downside now?
So, Nikunj, it's like this. Yes, the market has corrected, and normally, whenever the market corrects, it corrects very viciously. And that is what has happened. How long it will continue, I really don't know. But do I see an upside from here? Yes, I do see an upside. And this is not the end of the bull market, as you say. I think there is a lot more still going to happen. And as I think Templeton has said, I don't remember, that whenever there is blood on the street, and even if it's your own blood, that's the time to buy. So that I think will answer.
So, okay, so let's first understand that why markets have fallen. Then we'll talk about, whether that is blood or water. So markets have corrected because of two factors.
Yeah.
High valuations and slowdown in earnings.
Yeah.
Have valuations corrected enough even after the correction?
Correct. Okay. So let me just give you a parallel to this. Way back between 2003 to 2008, we saw market going 2002 to 2008. We saw markets going up about 6.5 times, and there were many corrections, 10%, 15%. But the largest correction which I remember was in 2006 May, when the market dropped almost by 30%. There was no reason, practical, specific reason. People said that FIs are booking profits. People said that there is likely to be a slowdown in the Indian economy. Globally also there are a lot of uncertainties. As well as they also said that basically valuations had run ahead of time. And that is when the market came down by 30%. So most of the stocks at that point in time, which were the leaders like ABB, Siemens, Voltas, and many others, they came down anywhere between 25 to 40%. Now, between 2002 to 2006, the market had gone up by 2.5 times. So at that point in time, probably what they were talking of was justified also. But when it comes to slowdown, that time also there were no reasons to think about it. And even now, I don't think there are any reasons to think about it. The other reasons which were given at that time have been given now. So I think this is a correction in the long-term bull run, and that is the reason. If you ask me, is the correction enough? I think in most of the cases now the stocks are trading at reasonable levels after considering the growth which they can deliver.
Okay, so markets have corrected. We have identified the reason. There were excesses. Earnings have slowed down, and valuations were attractive.
Correct.
Your view is that the earnings slowdown is temporary. Things will pick up, and valuations are looking attractive for a long-term investor like you.
Yes, okay. That's correct.
The world is changing, and I'm keeping the flow part aside because nobody can guess what FIs would do. But the world is changing because of tariffs and because of deglobalization. These are strong permanent changes which could have impact on global growth, supply chains, etc., etc. How much of that the markets are factoring in?
So there is uncertainty. I definitely agree. And as you said that there is deglobalization, there is a tariff threat which is there. But let's look at India. When it comes to India, and major of these worries are coming from the United States. So if I look at India, India does depend on the United States for software exports. But US also equally depends on India for software. So software services. So I don't think there will be any tariff implications there. Coming to other things, it's
Pharma.
Even pharma. Though Indian pharma are the largest suppliers to the United States also depends on it. So I don't think there will be any major tariffs which will come in. Many of the pharma companies in India who export to US have set up a plant in US as well. So I don't think even those tariffs are going to be impacted. There will be some impact, of course, on commodities. And but there again, if you see, US will be importing inflation because of these tariffs, and these could be short term. So I'm not so concerned about it.
We'll refer to this data for the benefit of our viewers a little later, but the US healthcare cost is growing at 7%.
Yes.
US economy is growing at 3%.
Correct.
You put in tariffs, you actually make medicines more expensive.
Still expensive.
And why would you want to do that when your deficit is already ballooning?
Absolutely.
So increasing tariffs on pharma is like you're trying to you're trying to shoot your leg.
Yeah, absolutely.
Okay.
Absolutely.
So in this decline, if pharma stocks have fallen, with the assumption that pharma tariffs are not going to be stiff, should one buy into the US exporters like a Sun Pharma or a Lupin or Aurobindo, companies or Cipla, which export to US?
So I would definitely look at the quality of management before investing. But yes, this is an opportunity there, because all these companies which you mentioned, they not only, so US is only a one leg for them. They also have an India leg, and they also have a rest of the world leg. And all three are likely to grow. So yes, I will be definitely looking at pharma as a whole for investing.
Okay. Let's look at India now. We are seeing two parallel trends in India. One, the government capex, which is slowing down, and second, consumption, which is bottoming out. Which is the better side to lean on now?
So I think a combination will be better. When it comes to consumption, yes, government has given a direct benefit now this year to many people, and I think that will help significantly. Also, in terms of capex, government has kept the capex at the same level what it was in the previous years. So I don't think there will be any major impact. But within capex, I would like to invest in those companies, especially companies in power and power ancillaries, where the opportunity still continues to be large.
Okay. So let's understand consumption. The fact that 1 lakh crore will come back into the hand of consumer made everyone excited. Yes. But not every rupee will go into consumption.
Correct.
Not every category will get a demand resurgence.
Correct.
And there are few categories which will gain disproportionately.
Yeah.
So this entire tax benefit cut, which has come back to the economy, which are the set of companies which would benefit?
Set of companies, rather than that, I'll give you the overall segment. So I think retail will benefit, whether it's apparel or grocery, that will benefit significantly. I also think pharma will benefit, because as you know, in India, after removing the day-to-day expenses and your real estate EMIs and all that, people unfortunately have very little disposable income, where pharma also gets impacted, not at the higher end, but lower end definitely. So pharma will be benefited, and hospitals will also be benefited.
Okay. So low ticket...
and finance, which I forgot, because whenever you start spending, you normally leverage and spend. So because of that, that's what even the government is looking at.
Okay. Yeah. So low ticket, aspirational, lifestyle dominated categories are the ones which you should really be focusing on.
Perfect. You put it just right.
Okay. So now let's start looking at retail. When we spoke to you last time, you were of the view that quick commerce is important and crucial, but valuations were absurd.
Yes.
Big box retail, let's say a V-Mart or a D-Mart, they are necessary and markets are disregarding them.
Yes.
What is the script? How do you think the script of retail stocks would move now, including both quick commerce and big box into one category, retail?
So let us look at quick commerce first. There are certain factors which drive quick commerce. A is basically the nuance of quick commerce. Second is that where it can do very well is where there is a high population density and where there is a high per capita income. So major cities are somewhere where quick commerce will continue to grow and will do very well. But at the same time, what happens is that even now, most of the Indian households, they buy only what is extremely essential from quick commerce. The balance, like if I want to buy, say, 5 kg atta, normally I won't buy from a quick commerce guy, or I'll go to a larger store and buy from there. So I think even in these cities, the old style or the old format stores, like whether it's Avenue, V-Mart and so on, they will continue to grow, but their growth probably will be higher in the smaller towns. While as when it comes to e-commerce, they will also continue to grow, but their growth majorly will be in the larger towns. So that is how the bifurcation will be when it comes to grocery. But otherwise, I think both will do very well. Though over a longer period of time, I think that quick commerce growth is restricted to towns and cities where there is large population and high population density, both. Plus, there is a high per capita income. While as in case of the smaller towns where the per capita income is not so high, I think there the old type grocery formats will continue to do well.
It's interesting you're saying that, because I remember when the birth of modern retail took place in India, everyone thought the Kirana wala will go away.
Yes, absolutely.
So what has happened is that some of the big corporates who came into modern retail, they've decided to go back, and the Kirana wala is still there.
Yeah,
so the same could happen to the existing players now. Quick commerce, some players may actually may go back, but the existing traditional big box retailer will be there.
I think so. That is what will happen. And quick commerce is frankly eating away more into the local kiranas.
Okay.
Because earlier they used to deliver you at your home, but here, as I said, it's app based, there is nuance. People tend to forget that you call your kirana wala and he will also send you. But this 5-7 minutes delivery fascinates you. This fascination may remain for some time, may go away also, I don't know. But yes, as of now they are doing well, and I think they have got a good opportunity within the large cities.
So if someone has to, let's say, take a genuine 3 to 5 year horizon, is one better off buying a Zomato stroke Swiggy, or one is better off perhaps going back to the classic D-Mart and the V-Mart?
So I am a conservative investor, so I will buy both. That's what I have done in our portfolio also. So we hold the old format, in the sense the large grocery stores also, and we own Zomato also.
So what is the logic in buying both when you are convinced that there would be a tumble and a rubble in quick commerce?
Yes, but I still feel there is 5 years growth there.
Okay.
So that is the reason why, and beyond that, I don't know whether Indian cities, it's possible that some of the Indian cities itself will grow larger. So that is the reason why I have taken a bet in Zomato. And large format grocery stores, I think, will continue to give.
The second powerful trend right now in the consumption basket is tourism,
Yes.
well-being,
Yes.
experiential travel.
Yes.
Is that a multi-year story? Because some of these stocks have really appreciated quite handsomely from the recent lows. Is this entire spiritual tourism, wellness tourism, weekend travel, is that a real deal?
So, yes, there is an opportunity, but only time will tell whether, so we do hold a hotel stock in our portfolio, and we also hold a travel stock in our portfolio. Now the issue there is that if I go back, because I keep going back and recheck my notes. So if I go between 2003 to 2008, we had hotel stocks going up nearly 10 or 12 times. We are already up by 7-8 times. So from here, whether there will be a significant growth, I don't know. Maybe there will be. But as of now, I'm not buying any of these stocks. Whatever I have, I continue to hold.
Which are the high growth pockets according to you in India for next 3 to 5 years?
So retail will continue to be there, of course. But besides that, I think transformer companies are likely to do very well.
Transformer companies?
Transformer
Okay.
companies. Power ancillaries or related to power, they will do very well. I have not taken any call on power generators. Maybe they will be interesting, but frankly, I have not taken any call on that.
When you say power generators, are you also tempted to look at this entire clean, green, solar binge, which markets are excited about?
Yeah. So as of now, I have not done that, because I think there will be a period, next 2-3 years could be good, I don't deny that. But beyond that, I think competition will come in. So that is the reason why I am not so keen about investing in companies which are into green power. Incidentally, I'm just giving an example. Take for example Hitachi. Hitachi manufactures HVDC transformers. Now there, they are required for when renewable energy moves to the grid. So I will rather play it through that than investing in a grid company. Again, no recommendation. We have been holding for this stock for a long time, both in our portfolio and in personal capacity.
You held on to trend for years now.
Yeah.
And at 8,000, the temptation to sell, I think, was obvious because the P multiples have become wild.
Yes.
The stock is down by 30% plus.
Correct.
It has lost almost 1 lakh crore in terms of market cap.
Yeah.
Is trend looking attractive again?
So yes, again, let me clarify very well that this is not a recommendation. We hold trend. We have been holding it for a very long period of time. I have it in my personal account also. And this is no recommendation. So let me talk about Trent. Yes, Trent has come down quite a bit. And we did sell Trent at a significantly higher level, but we did not sell the entire quantity for simple reason that we do think that this is a very, very long-term growth story where it can compound over, say, 10 years period at 25%. That makes it a 10 bagger even from the current level.
So the current market cap of about 2 lakh crore?
So I don't look at it as market cap. I am talking about the top line growth. If top line growth is 25% year on year, it's possible that it will become 10 times in the next 10 years.
The size of the company can become 10.
Yeah. So I see that because that kind of opportunity is there in India. And if that happens, then automatically price will follow. How much it will follow, I don't know. But even then, and at least for next 2-3 years, probably the growth will be higher than 25%. That's what we believe. And that is the reason why I think that at this price, Trent could be an interesting company.
Which are the other companies where you think that according to your assumptions, a growth of 20 to 25% for next 5 to 7 years is fairly easy to predict? What happens to stock prices is a function of markets, valuations, technicals. Yeah. But where are you able to predict the business? I mean, apart from Trent, that you see a growth of 20% plus.
So 3 to 5 years, I think even companies in quick commerce will do well.
Okay.
The second is in hospitals. Some of the hospitals can grow at that price. Pharma, I don't know, because pharma, it will totally depend on how fast our per capita income moves. If it moves from $2,500 to $5,000 in the next 5 years, there is a possibility that in pharma also you will, because Indian pharmaceutical growth, frankly, if you see any lags quite a bit, anywhere between 8%, 10%, sometimes even 6%. So that needs to grow first. The market needs to grow, and that is where I think the opportunity lies. So if one is betting that, and I do take that call, that the overall per capita GDP will move up from $2,600 to about $5,000.
But in this market decline, have you started shopping? Because last time when I spoke to you, you said that you had finger on your lips, right? You were not buying or selling anything.
Yeah, that's true. So we did sell at a higher price, some of the stocks. And we have started buying. In the newer accounts, we still have about 40% cash.
40% cash.
Yes, but we are deploying. It's not that we are not deploying. And if the market remains like this, I'm sure in the next couple of months, we should be fully invested.
We spoke about insurance last time.
Yes.
But unfortunately, the terrain continues to be bumpy for that space.
True.
From a regulatory standpoint, from a competitive standpoint.
Correct.
When will the tide turn for the insurance sector?
Again, a slightly difficult call to take, but again, I think a lot will depend on the income moving from $2,500 to $5,000. So if you are a person who believes that the overall India will not get stuck in the middle income trap and will continue to grow, and the income will move up from $2,500 to $10,000 in the next, say, 10, 12, 13 years, then insurance is the right spot to be.
So one has to take a bet on insurance. Which way one should lean, general or life?
I think general.
General.
Yeah.
But isn't that space getting competitive?
It is getting competitive, but there is a lot of opportunity also.
Where are some of these so-called...
Or you can also invest through, what are they called? TPAs, third-party administrators.
What is the best way to understand the digital story of India? I mean, everything is becoming or is moving towards AI or digitalization.
Yeah.
Digital companies are gaining market share. They are gaining more and more mind space. They are getting more and more wallet space. If someone says that, look, I want to bet on digital India, what is the best way to bet on it?
Frankly, you will have to look at companies who are taking advantage of this. Like take for example, retailing companies. They need to be present in all the three sectors. They need to be present on the net. They need to be present in a brick and mortar format also. So you'll have to look at those companies who are not ignoring the digital growth and also developing their digital platform. If that is happening, then I think the companies are there. There should not be a problem. I don't know about a specific company who is into a digital platform and over a period could do well. But yes, there are companies in travel which are looking interesting, and we are looking at those companies but have not taken a call so far.
Why is IT doing well? I mean, I'm talking about the classics. 7-8% growth. They are gaining, the stocks are only gaining because of buybacks.
Yeah.
10% growth with P multiples in the mid-teens, early 20s, by any yardstick is expensive, but they are still outperforming.
So they are outperforming because the market is down, not otherwise. So what has happened is that these are the stocks where people say that smart money hides. I don't know. I prefer to hide in InvITs. I don't hide in stocks because it doesn't make sense for me. InvITs is a fixed return kind of opportunity where whether it's InvITs or whether it's REITs, I would rather hide there or than hiding in stocks, because if I see over the next 4-5 years, is there chance of these companies growing significantly? The answer comes negative. Great companies, good management, clean balance sheets, but growth is not there. So that is the reason why we are underweight on technology.
In general, what should be an approach with small and mid-cap stocks now? I mean, they believe since you are a practitioner and you understand and you look at market history very well, there are times when small and mid-cap stocks do well. Yeah. Doesn't matter what company or what P multiple, as long as it is small or mid-cap, it will do well. There are times when large caps do well. Yeah. Again, markets, they tend to ignore valuations. So are we going to hit that patch where doesn't matter how good a company is, but if it is small and mid-cap, it will not do well?
I hope that happens, so that will be a time to buy. But so you have to look at those companies which may be small or mid-cap, because I remember Voltas, when we recommended first, was a 150 or 200 crore top line company. Same thing with Trent also. Same thing with Titan. Titan was slightly bigger because it had watches business, but in jewelry it had just entered. So you have to look at companies where, though they are small caps or mid caps, ideally a small investor should look at mid caps rather than looking at small caps. But look at those companies which can become large companies, where the opportunity is such that they can grow 10 times, 20 times over the next 10, 20 years. Don't look at what will happen tomorrow or day after. Look at the management. Another way of looking at the management is look at the auditors. Good auditors probably say that the management should be okay, or at least you can rely on the numbers which are given in the balance sheet. And if you are comfortable, if you are confident that the opportunity is large, then go and invest and sit tight. If it falls, buy more.
So in this market fall, you will look at a business. Doesn't matter which market cap or which bracket it falls in.
No, doesn't. We always prefer bottom-up approach, and that will continue to be there. Small and mid caps, yes, they give an opportunity, but you need patience as well.
So if you do a dipstick with some of the savvy investors and folks who've seen market cycles, they're openly going on public forums and are saying redeem your SIPs in small and mid-cap stocks. Valuations are looking at small and mid-cap stocks. Small and mid-cap party is over. Diwali khatam hai. Delhi bahut dur hai. Why the narrative in the market is so strong that avoid small and mid-cap, only go to large cap because they are cheap?
So that is because most of the people, including investors, small investors, larger, they are looking at what will happen in next 1 year. Mm-hmm. So if you have only that focus in mind, it makes sense to get into large caps and hold on to them, because the fall probably will be less. But at the same time, if you are planning to build your wealth, then I think you should not disregard small and mid caps. But don't buy small and mid cap because someone told you, or because you think that the price will go up, or because someone is there in the stock. That doesn't make any sense. Look at the business. If business is interesting and the management is good, invest in that.
I cannot urge enough on this forum. I'm doing that on a regular basis, that when you buy a mobile phone, you pretty much would look at all the possible price points where you can get a deal or a discount. Absolutely. Or a cashback. Similarly, when you're buying a stock, it cannot be a tip in a lift. It has to be more than that. It is your money. So just like when you're buying a mobile phone, you do due diligence. I think in stock markets also, you need to understand what you're actually buying. But that's like a standard example which I give everyone, that you should know what you buy, because when stocks will come down, it is only your understanding of the business which will save you from that market nervousness.
Absolutely, you put it just rightly.
I go back to that same point once again, that if the wealth creation journey, the rules remain the same, but stocks, they change.
Yeah.
So if somebody has to genuinely stay on course for next 5, 10, even 15 years and wants to really create wealth, how do you see the next 5-year wealth journey moving? What would be the basic factors at play?
So it will be, of course, GDP growth is the key. So that continues. You should have an eye on that, and that should continue. I mean, some kind of a slowdown, 6.7% to 6.5%, or don't get overexcited also when it 6.7% moves to 8%. But as long as there is anywhere between 6.5 to 7% growth, I think the overall nation will do well. And if that happens, if the per capita income goes up, I think the economy will also do well. And I have seen over a longer period of time that what happens is that stock markets typically grow, if I'm not mistaken, I think 1.6 times the nominal GDP growth. So you keep that in mind. So then I think by that criteria, I think the market should double over a 5-year period. Sometimes there is a dip, but they correct. So over a 5-year, I think nominal GDP growth is what you should keep a look at. Invest in good companies and expect that the market will grow slightly higher than that. So when you are investing in the stocks, I think anywhere between 15 to 20% growth over a longer period of time, compounded, you should be happy.
What is your checklist manifesto like? When you look at a company, what is that 1, 2, 3, 4, 5 which you look at before you say a yes? Because you hardly say yes. But when you say yes, what is that 1, 2, 3, 4, 5 you look at?
Okay. So one is great business.
Okay.
When I say great business, it has to be a business where there is a huge long-term potential. And in India, you can find many of these because we are still a developing economy. The second is the quality of management. There are 3-4 ways of checking at it. Of course, being in the markets for so long, you have some idea. But at the same time, whether there is a change of auditors, whether any big four have come in. But at the same time, it should not be that it has happened only for the sake of IPO, and after that the auditor changes again. So that is other thing. Financials, of course, are very important. I also give a lot of weightage to leverage. So I don't buy stocks where the leverage is very high. In fact, most of the stocks which we own are with zero leverage. So that is that, and buy it at a price which justifies the growth in the company over a long term.
Okay. So that's the filter criteria which you really look at.
Yes. Apart from ROE, ROCs, but many a times what happens is if the company is small and if the company is developing its business or growing its business, it's all right if the ROCs are low. But if you can project it for 5 years and see at what point in time the ROCs start picking up, I think that is the way you should look at it.